Hey there and welcome to the channel. In today's video, I want to go over the new fund from Mohnish Pabrai, which is called Pabrai Wagons Fund. I want to start the video off by going over the investment philosophy that Mohnish has for the fund, and then check out some of the biggest holdings that he has invested for the fund to try to decide if this is actually a good investment opportunity for the normal retail investor, because Monis has another fund that has been hard for normal retail investors to go into, because the minimum is something like $1 million to $2.5 million, which for most of us is too much money, and also will be able to track the performance of Mohnish, which has been hard to do so far. So like I said, the fund is called the Pabrai Wagons Fund, and the ticker symbol is going to be WAGNX. And it's available for purchase at Interactive Brokers and Vanguard. Now, he started the fund last September with the initial net asset value of $10 per share, and the fund is long only in public equities, and he is investing globally, and the fund is going to be concentrated with a target of 15 to 25 businesses, and of course he's going to be buying these businesses when they are being offered at a meaningful discount to their underlying intrinsic value, like a true value investor. Now, as of the end of last year, Monis is managing approximately $840 million in assets with this new fund and some other private partnerships that he has. So he's managing a lot of money. It's going to be difficult for him to keep outperforming the market. And as we know, Monish is a disciple of Warren Buffett, and he's closely following the principle of Benjamin Graham of value investing and good capital allocation. Before we look at the top holdings for Monish in his portfolio, I want you to remember the fund's philosophy, which is to circle the wagons. And he's quoting Charlie Munger here with the first rule of compounding is to never interrupt it unnecessarily. And he also talks about exceptional investment performance is usually the product of only a few great investments, which are held for a very long time, which is something that I definitely agree with. And like American pioneers, the fund will circle the wagons around its highest conviction holdings. Monish is also quoting Warren Buffett here from the 2022 letters to shareholders, where most of the returns that Berkshire has had is from about a dozen truly good decisions. That would be about one every 5 years or so. So between the years 1965 to 2022, they made about 80 plus business acquisitions. They did about 210 plus investments in common stocks, and 10 plus key hires by Buffett himself, which means it was about 300 plus important decisions over 58 years. So out of those 300 decisions, 12 were truly good ones, or about 4%. And Moniz believes that these decisions were buying Geico, where they originally bought stock in the company, and then they bought the whole company many years later. They bought a significant amount of stock in Coca-Cola. I think it was in the 80s, probably. American Express first in about 64, something like that. See's Candies in the 70s. Apple, it was pretty recently, back in 2016. Um, BNSF was sometime after the financial crisis. Mid-American Energy around 2000. National Indemnity Company around 1960 something. Gillette, I don't remember exactly when that was. Washington Post, they held that for a very long time, probably 40 years or something. Then Capital Cities, ABC, where Tom Murphy was the CEO. And then the decision of hiring Ajit Jain for the insurance business. I think these 12 investments are spot on from Moniz. They are probably the most important decisions that Warren made in his career and have contributed to most of Berkshire's success. And Pabrai talks about here that these were all very long-term bets. So what was more important for Berkshire than the actual decision to invest in these assets was the decision to remain invested in them over a very long period of time. And the key principles for the fund are pretty straightforward, and I would say I agree with all of them. He doesn't want to cut the flowers and water the weeds, which is something that I believe Peter Lynch said. And you want to hold on to great businesses for dear life. You don't want to pay fancy prices for great businesses. Even though they are the best businesses in the world, it doesn't mean you pay just any price for them. And then he wants to focus on the great business with great people and long runways. He wants the business to have a wide moat and very important, the proven ability to reinvest capital at high rates without using too much leverage. So far, so good. I agree with everything that Mohnish has talked about, and it's very similar to my investment approach. Now, let's take a look at the top 10 holdings as of December 31st, 2023 for the fund. And as we can see, there are three companies from Turkey, one from Canada, and the rest from the US. And this is probably the majority of the portfolio. You can see the portfolio weight is 10% in the Turkish Coca-Cola. Now let's quickly check out these companies on QuickFS to see if they are really the high quality companies that Mohnish is talking about. Now I couldn't find the financials on the Coca-Cola company in Turkey, so I was able to pull up this one, which is called Anadolu Efes, something that I can't pronounce. But basically, the company is in Turkey. It has a market cap of $2.8 billion, and it's a company that engages in the production, bottling, distribution, and sale of beer, malt, and non-alcoholic beverages in Turkey and internationally. Okay, right away we can see that this company is really not high quality. You can always see it on the long-term return on invested capital graph, where if you look at high quality companies, you can see the return on invested capital being pretty steady, maybe rising over time, where the return on invested capital is getting better and the profits are expanding. This company, on the other hand, could be some kind of asset play where we see that price to book is below 1. So the assets could be valued much higher than the actual market cap of the company, since we see also the company is pretty cheap at an enterprise value to free cash of only 7. So this is a company that I would have to pass, and it doesn't seem to suit the circle the wagon type of company which you would hold for a very long time. This is probably something you would buy and get a good return in a couple of years at the most, because you bought it at such a cheap price. Now the next company he has is called Consol Energy with a market cap of 3 billion, and it is a coal company. So right away that tells me that's deep value, not a high quality company that is buying for the long term. This is a short term play. And you can see the graph for the return on invested capital. It's super cyclical. It has a very low enterprise value to free cash and a rather low price to book. And the average median return on invested capital is only 5%. So this is also another company that doesn't really fit the criteria of holding for a long time. Now this is another company that I've heard of. I've seen people talk about it on Twitter. It is called TAV Airport Holding, which is in Turkey as well. And it has a market cap of 1.5 billion and an enterprise value of 2.6, which means that the company has some debt, probably quite a lot of debt. If you look at the debt to equity, which is 1.8, and you can see the return on invested capital is all over the place, with the median being 6.9%, and they are actually negative in their free cash flow, which is something I never put my money into. If it's negative free cash flow, I don't like investing in it. But the price to book is only 1.1, so this is probably another asset play from Mohnish. Now, I'm not saying that he won't make a lot of money buying these companies. He could very well make a lot of money and just crush the market. What I'm saying, it doesn't really fit with the strategy that he's putting forward of buying high quality companies and holding on for dear life. Now, the last company I want to look at is a company that you probably recognize. It's been in the news quite a lot for the last couple of weeks, which is called Spirit Airlines and has a market cap of only 729 million, but an enterprise value of 2.8. So the company seems to owe a lot of money. Their return on invested capital is all over the place. Like we can see, it's an airliner. So personally, I won't be putting my money ever into airliners, but that's just me. I know people that have made money investing in airliners. You could do that. That's just not my style. The company has negative free cash flow, and the average return on invested capital is pretty low and pretty volatile, like we can see here. The price to book is low, and this is another deep value play from Mohnish. So most of the portfolio seems to be in deep value, but I've taken a quick look at all of these companies, and obviously I know Microsoft and Constellation Software, they are high quality companies, but he started the fund in September, so it is very likely that he's paid a very fancy price for both Microsoft and Constellation because they aren't exactly bargains. I think everybody in the market realizes that those are really high quality companies. So they're priced according to that. Now, Microsoft, of course, is a $3 trillion company. So I don't know what the growth prospects are for such a big company. I also want to show you the minimums for investing in the fund, which is only $2,000. So most retail investors should be able to invest with Mohnish if you are interested. And the net expense ratio is 1.25%, which I think is fair. But if you look at the fine print, you can see that the gross expense ratio is actually 1.91%, but the advisor has agreed to cap the fund operating expenses through October of 2025. So the fees will go up. But it's going to be exciting for those of us that like to keep track of Mohnish and respect him as an investor to be able to see how he's doing with this new fund that we can see the pricing on. It'll be interesting to see if this will be at $20 or $30 in 5 years. Could be. But just to conclude this video, I'm not personally interested in investing with Mohnish, and it's just because of the quality of companies that he's investing in. I could only see two companies that I would actually put my money into, and they are both, in my opinion, very overvalued. So I would say that even though I agree with all the principles that Mohnish is putting forward in his presentation, I don't think he's actually following through on what he's talking about. But that doesn't mean that his results won't be really good. They could be very good. But it's similar to back in 2021 when he was talking about changing his investment style to replicate Nick's sleep and only invest in high quality companies and hold them for a long time. Now, obviously, he hasn't done that. We've been tracking his 13 Fs and we've seen the companies that he's been buying, and he's been turning over companies at a very high pace. So I think it's very likely that Mohnish will be following the same playbook with his new fund. But I won't be making this video any longer today. I want to ask you to like and subscribe if you haven't already. Thanks for watching, and I will catch you on the next one.